Hello everyone, I hope you all are doing well. Since we are not meeting this Thursday night, I made a short lecture video on chapter 10. I hope you all will read the chapter, read the slides, and watch the video. Next class, when we will meet, we will practice a few problems from chapter 10. So you really need to have some concepts on chapter 10. We will also play some Kahoot game on chapter 10 next week. So let's start. What is this chapter about? This chapter is about foreign financial statement translation. If you remember in our prior chapter, chapter 9, we just saw one or two foreign financial transactions. But here we will see when you will have a subsidiary in other country and they are preparing their financial statements using different currency, different accounting standards. So how you will convert those into dollar values. So when we talk about the conversion of financial statements, it means basically the three parts that we will focus. Of course, income statement and balance sheet. You will also see how we can convert the statement of retained earnings. So here, when you will have a subsidiary in a foreign country, you need to think about two things: what the accounting standard they are following, and what the currency they are using to record all of their transactions and prepare for preparation of their financial statement. So if they prepare their financial statements following other standards but not GAAP, then we also need to convert those foreign accounting standards, either IFRS or their local GAAP, into US GAAP. And if they are preparing their financial statements in different currency, of course, we need to convert those into US dollar, because you are the US parent and you need to do all these conversions before doing the consolidation. We just cannot add one financial statement which is in US dollar and the other financial statements in different currency. So now we will see how we can convert a foreign financial statements. So here we also need to focus on two items. One is what method we gonna use. You will see that in this chapter we will learn two methods, and we will also learn a concept which is called functional currency. And depending on the functional currency of the subsidiary, we will select the method. And you also need to check another important thing, which is the results after conversion, where you have to report the results. When we convert a foreign financial statement from a different currency into US dollar, you will end up with some foreign financial exchange rate gain or losses. So, for the second point, we also need to figure out where we will show those gain or losses. There are two places to show any type of gain or loss. One is, of course, the income statement. Another is you can bypass the income statement and you can report it on your balance sheet under the stockholder equity part, labeling it as OCI, other comprehensive income. So we will see two methods, and we will also see how the foreign exchange gain or loss after conversions are reported in different places of your financial statement. So the two methods that you are learning today is the current rate method, and another one is the temporal method. So these all methods will be applied from the perspective of a US company, and the US company is using the US dollar, and of course the US company is the parent company and they have subsidiary in other countries. So just to identify two methods, I have used green color for all current rate items, and then I use this pink color for temporal method, but it's fine. You just need to remember what's the functional currency and what method you have to use. And the good part for this chapter is that you need to use this big chart, and this chart will be provided during the exam. So you don't need to memorize this chart. So let's focus on this chart. So you see here, the left side of this chart, you are seeing all the items from your balance sheet. And you will also see all the items from your income statements, right? For balance sheet, you have assets, liabilities, stockholders' equity, and these are the common items of an income statement. Now, depending on the method that you are using, you have to use the exchange rate listed here to convert the foreign currency into US dollar. Remember, your subsidiaries' financial statements are reporting using different currencies. Now, if you need to convert those into US dollar, you need to use an exchange rate. But we know exchange rate changes every day, right? Exchange rate fluctuates and it can change for different factors. So which exchange rate you gonna use? This chart will tell you the exchange rates that you have to use. So current rate always means, here you see several items we are using current rates. Current rate means the day's rates when you are doing the conversion, and we do it at the end of the fiscal year. It's the same date when we prepare our balance sheet. So just remember, current rate means the date when you prepare your balance sheet. Then you will see here historical rates. Historical rates means the rate that is from the day when you first recorded that item or recorded that transactions. For example, plant, property, equipment. When we convert any plant, property, equipment for a foreign subsidiary's balance sheet, and that's in another currency, you have to look at when you first recorded that plant, property, equipment, what was the exchange rate on that day. That means when you purchased and recorded those items, that day's rate will be the historical rates. So this is how you will convert the items, either using the current rate or historical rates. Now you will see here average. So these average rates are used usually for reoccurring item, and of course it's for the income statement items. For the current rate method, you will see all income statement items will be using the average rate. On the other hand, for the temporal method, only revenues and expenses will be using the average rate. And the other items you will see, it's mixed historical rate, because some items are related to long-term assets and it's assumed that revenues, expenses, regular expenses, those are regularly occurred items. Now, this average rate means what? Average rate means if you take all the exchange rate for a certain period and you take the average. And the good part is that all exchange rates will be given. Current rate, historical rate related to specific items, and of course average rates will also be given. Now, you will also see these two items, and that is applicable for retained earnings, which is called composite. What does that mean? Composite means that for retained earnings, we do not use any exchange rate to convert it. Rather, this is the results. This is a composite results after doing all conversions. So you can also say in another way, this is an imposed number to match your financial statement, balance sheet, and converted other numbers. And that's why it is called composite. Now, what we will do here, we will go over one example and we will go over both methods. One is called the current rate method, another is called the temporal method. So we will start with the current rate method because current rate method is easy to remember. But you don't need to memorize anything. Again, it will be given during your exam.